welcome back. Welcome to the fifth and final session of this Young Investors webinar series. I'm sure you know us all by now, but I'm Rachel Winter. I'm one of the investment managers here at Killik, and this is my colleague Tim, who's our head of education. And then behind the scenes, as normal, we've got George, who will be manning the chat function. So any questions that you have throughout the webinar, pop them in the chat box and we'll do our best to get to those at the end. As I said, this is the fifth and final session. So let's just have a look at the agenda that we've been following throughout these 5 sessions. I'm just going to share my screen. So we started with an introduction to investing and we talked about how to look for investment ideas. Then you guys went away and you looked for your own investment ideas. And then we had a vote on exactly which ideas to put in our own virtual portfolio. Then we put that portfolio together and we've been following it virtually ever since. So this week we'll be having a look at exactly what that portfolio has done since our last session 2 weeks ago. And then Tim every week has been doing a 10-minute session on a different educational item. And today he'll be talking to you about funds. So as always, let's have a look at exactly what's happened in the market since our last session, and then we'll have a look at our portfolio and exactly how it's performed. So before we do that, let's just have a quick reminder of exactly what stocks we've got in our virtual portfolio. We've got 12 in total, and here they are on the screen. So we've got Alphabet, which is the owner of Google, and is also the owner of YouTube. We've got Amazon, obviously one of the biggest e-commerce platforms in the world, also very big in cloud computing, and it also owns Twitch. Anheuser-Busch InBev, that's the biggest beer company in the world, owner of Budweiser. Then we've got Astrazeneca, big medical company, famous for making one of the coronavirus vaccines. Beyond Meat, making meat substitutes. International Consolidated Airlines Group, that's the owner of British Airways. Then Lloyds Banking Group, that's one of the biggest banks in the UK. Newmont Corporation is one of the biggest gold miners in the world. NIO is an electric car company based in China. Northland Power is a wind farm developer over in Canada. Peloton, as we all know, is that an electric bike company. And then Xylem is what we call a water technology company. So that's the 12 companies that we've got in our portfolio. Now let's have a look at what's happened in the market since our last session 2 weeks ago. So here on the screen, we've got various different stock indices. In the green, we've got the FTSE 100, so that's the main UK index. Then in the pink, we've got the S&P 500, that's the biggest 500 companies in the US. And then in the blue, we've got the NASDAQ Composite, that's another US-based index, but it is very focused on growth stocks and on technology. Now, the black vertical line that you can see, that shows what these indexes have done over the last 2 weeks since our last session. So as you can see, the FTSE in the green and the S&P in the pink haven't really done much at all since our last session. But in the blue, you can see the NASDAQ Composite has come down a bit. And that will have an impact on our portfolio because our portfolio is quite focused on these growth stocks. So the fact that the NASDAQ Composite has come down a bit, that does imply that perhaps our own portfolio might have come down a bit too. Now, over the last couple of weeks, we have seen a little bit of weakness in some markets, and part of that is caused by the fact that people are worried about a third wave of the coronavirus. And this has been quite well reflected in the oil price. So Brent crude is the main type of oil, and this is the price over the last year. Now, oil is mostly used for running factories and also for transport. So clearly in lockdown, there hasn't been any demand for oil at all, really, because factories haven't been running and no one's been allowed to travel anywhere. However, as the lockdowns have lifted, people have started thinking, right, we're going to be moving around again, we're going to be using transport, factories are going to be opening again, therefore demand for oil is going to go up. So we've seen the price of oil gradually recovering, and particularly over the last couple of weeks, or particularly over the last couple of months rather, the price has actually moved to quite a high level. However, over the last couple of weeks since our last session, there has been some concern about this third wave of the virus. There has been obviously another lockdown being announced in Germany, and that has made investors a bit concerned again. And therefore, we have seen people moving out of some of these stocks that might do well when lockdown lifts. And so that has caused a bit of a sell-off in the oil price, as you can see by this chart here. Something else that's happened in the last couple of weeks, the UK inflation basket has been adjusted. So we've talked about inflation a couple of times. Inflation is simply the gradual rise in prices that we see in the economy gradually over time. And we work out inflation by measuring the prices of different goods and services. And every year we have to readjust the prices of the particular goods that we're measuring because the types of products that we're buying over time are going to change. So for example, if we go back 20 years, we probably would have included things things like record players and cassette tapes in our inflation basket. Then that would have changed to CDs. Then it might have changed to iPods. And now it's probably changed to music streaming services like Spotify. So it's important that we adjust our inflation basket so that we're always measuring the prices of goods and services that are actually relevant to what people are spending their money on. So it's always quite interesting to see how the basket has changed. So here are the latest 4 things that have been added to our inflation basket here in the UK. And they do give quite a good reflection of what's actually happening within the country and what potentially could happen going forward. So hand sanitizer has been added. So obviously when lockdown lifts, it is expected there will still be quite a big focus on hygiene. So that potentially will be good news for companies focused on hygiene products. Now, what's interesting is that the committee that put this basket together, they do try and focus on long-term trends. So they have said that they haven't decided to put face masks into the basket because they don't expect people to wear those once lockdown lifts, but they do expect us to carry on using things like hand sanitizer. They've also included smartwatches in the basket because they've become a lot more popular. They've also added loungewear, so that suggests that perhaps in future we will be working from home a little bit more, which perhaps means we will be dressing a little bit more casually. And then finally, electric cars. Previously, these have been quite a sort of niche item, but they are becoming more and more common and more popular. And now it's got to a point where they have been added into the UK's inflation basket. And on the subject of electric cars, we've had quite a big bit of news from Volkswagen over the last couple of weeks. Now, Volkswagen is one of the biggest car companies in the world. It owns lots of different brands, as you can see on the screen here. So it's got its main Volkswagen brand. It's got perhaps some lower priced cars such as Skoda, and then it's got some proper luxury brands as well. So things like Bentley and Lamborghini. So a real different range of vehicles here. Now, Volkswagen, unfortunately, is quite well known for this emissions scandal that happened back in 2015. So cars are only allowed to emit a certain amount of pollution, and they are tested to see how much pollution they are emitting. However, Volkswagen in 2015 was found to be cheating that test, and that was an absolute catastrophe for the company at the time. As you can see there in 2015, the share price absolutely fell off a cliff. So that was really, really bad news at the time. And since then, the shares have been quite out of favor. A couple of years ago, the company then announced that it would be moving into electric vehicles, and it said it would be developing 75 new models of electric vehicle before the year 2029. And I think at the time, investors thought, that sounds exciting, but it does sound quite ambitious. Then, as you can see in March 2020, lockdown started, no one was buying cars, and therefore the share price took another fall. However, this week, Volkswagen has updated the market and it has said, by the way, our plans to develop more electric vehicles are going very well. We expect to sell 1 million electric vehicles in this year alone. And what's more, we've got plans to open 6 different battery factories. So that's got investors really excited. And as you can see, there's been a really big spike in the share price over the last couple of weeks. And the reason why we think this is interesting is that we do spend a lot of time looking for new and exciting companies, but it's important not to forget that sometimes old companies that might previously been seen as quite boring can actually really turn themselves around and really reinvent themselves and actually become quite good investments. And I think that is an example of what's happened with Volkswagen here. And another great example of that is Walt Disney. Walt Disney is 95 years old. It's a very, very old company. Clearly, it started by making cartoons about Mickey Mouse. More recently, it's been involved with theme parks, obviously all the sort of classic animated Disney films. Sorry, I'm just going to go back because I missed a slide there. Let's go back to Volkswagen. So this shows over the last 3 months, it shows the movement in the Volkswagen price compared to the Tesla price. So what you can see is that perhaps investors have realized that the Tesla electric vehicle is no longer the only game in town. So we've seen investors moving into Volkswagen, as you can see by the green line, and we have seen a corresponding sell-off in the Tesla price. So that's something that's been really interesting over the last couple of weeks. Sorry, now back to Disney. So Disney's a company that's been around for 95 years, but it really has managed to reinvent itself recently. So Disney has realized that it really needs to own a valuable amount of content, and it needs to start trying to make money from streaming. So what Disney has done, it's bought a lot of valuable content, including Pixar, it's bought Marvel, it's bought Lucasfilm, which owns Star Wars, and Disney has launched its own streaming platform. So it's moved away from being a more traditional media company, and it's become a very successful streaming company, and it's already got 95 million subscribers on its Disney Plus channel, despite only launching it just over a year ago. So Disney is another great example of an old company that has managed to reinvent itself. And you can see that here by looking at the share price chart. This is the chart over the last 5 years. And you can see that between 2016 and 2019, the share price really didn't go anywhere. Investors were getting quite bored of the company. But over the last couple of months, since Disney Plus has really taken off, the share price has really accelerated. So in our point of view, Disney is another example of an old company that has really successfully managed to turn itself around. So I'm going to stop there. I'm going to pass you over to Tim, who's going to talk to you a little bit about funds. Over to you, Tim.
Well, thank you very much, Rachel. Great to be back for the final session. As usual, I'll be using a slightly unusual range of props to make my points. Funds. So common question is, rather than setting up a portfolio of individual stocks and managing that myself and choosing them, could I not pay a fund manager to do it for me? So imagine this pile of post-it notes is a collection of stocks. Could I not just say, Tim, I'll hand you some money, you go out on my behalf, buy lots of stocks, put them in a fund, and hopefully you'll pick the right ones, and you will do well for me. So a fund is just a way of collectively pooling lots and lots of investors' money together in one vehicle. So what is the point of a fund? Now, this is the advertising blurb, if you like. I'll give you the flip side of this coin. But fund managers would say, well, we offer lots of things to private investors, and all sorts of names out there, big houses running funds, an awful lot of choice out there. But they would claim to offer expertise, so you get the fund manager's knowledge and experience, diversification, picking these off one by one, so you don't have to worry about spreading risk. The fund will do that for you by buying what could be 100 or so stocks. Then there's no limit on the number potentially. Then there's less hassle. Give me your money. Well, a fund manager will say, own some units or shares. I'll come back to those in a moment. And you don't have to worry about having a diverse portfolio and lots of different corporate announcements coming in and dividends flying around all over the place. Just own my fund. And then finally, economies of scale. Because I'm not just asking you to invest, there could be thousands of investors investing. I can go out and buy big. Now, you don't have to necessarily take all those arguments at face value, but that is the kind of argument for a fund. An easy life, automatic diversification, and expertise. If you're not an emerging markets expert, a fund manager might be. Now, that leads me to how many types of fund are there? And this is actually quite important. So flipping my high-tech board over, there are 3 there. The unit trust, or in the US is called a mutual, near enough, the investment trust company, and the exchange traded fund. And these days, any of those can be either active or passive. So let's have a think about each one in turn. So unit trusts, first of all, the biggest type of fund around in the UK, if you like, the one you see advertised all over the tube in London on the side of buses and so on. What is that? That is basically a fund manager taking your money and unitizing it. And what does that mean? It means essentially you buy and sell units between you and the fund manager. The fund manager then takes the money that you've used to buy units, invests it in the market, builds up some net assets, if you like, and then every now and again will tell you how you're doing by giving you a unit price. And the point about a unit trust is that although potentially there are 2 different prices, there's the price of what the fund has bought in the market, all those shares the fund manager's gone out and bought, whether emerging markets, UK equities according to the mandate, and the price of the unit. And you'd expect the 2 to be connected. So you'd expect the valuation of these to be reflected in the valuation of those. And the unit trusts, that is the case. They're held quite close together. There's a valuation exercise done, say once a day, let's say, where the fund manager sits down, works out the value of these and works out the value of that using the 2 pieces of information. They're normally tied quite close together. Whereas number 2 here, the investment trust, what you're getting there is essentially you are buying shares in a company, the investment trust company, run by a fund manager, and it goes out and buys shares in other companies. But the company you're buying into is itself listed on the London Stock Exchange. So that's a slightly different structure. May have the same mandate. Could be the fund manager says, I'm an emerging market equity specialist, for example. So it may sound like a unit trust, but actually you're buying shares in a company. And one of the consequences of that, like any shares in any company, is that the net asset value of the investment trust company and the open market price of the shares you bought can vary. So you can get this happening. So you can have a situation where the assets held by the investment trust are trading at a premium, if you like, to the open market price of the investment trust of the London Stock Exchange, or the reverse, all right? Or put it another way, you get a discount to NAV or a premium to NAV. And that upsets some investors and excites others. They say, well, hang on a minute, if there's a chance to buy a portfolio at a discount, surely that could accelerate my returns if that discount closes. Maybe, but equally, some investors get a bit nervous about the fact that the net asset value of the portfolio and its market value, if you like, are two different numbers. But nonetheless, there it is. And then you've got the exchange traded fund. And that essentially is an exchange traded unit trust, if you want to see it that way. So an exchange traded fund is just basically quite often an algorithm, if it's run passively, that is set up to mirror the performance of something else. And that something else could be an index, like the FTSE 100, or in America, the S&P 500, or it could be a basket of stocks chosen specifically to meet a certain mandate, emerging market growth. But the point is, these days, all of these can be either active or passive. And essentially, the name does what it says on the tin. Is this a vehicle, one way or another, that looks to follow an active investment approach? So the obvious thing would be a human fund manager going out and tinkering with the portfolio they bought on your behalf, rebalancing it, getting different exposures, buying and selling different companies. Or is it purely passive? In which case it's set up to basically track the underlying index. To put it very simply, if the FTSE 100 rises 1%, you'd expect your share in the exchange traded fund to go up about 1%. It's never a perfect match because there's something called tracking error, but you'd expect broadly for that relationship to kind of hold. Now, you might be thinking this all sounds very exciting. So funds sound good. There's lots of choice, lots of different mandates, different structures I can choose from. Or you might be thinking it sounds quite confusing. All right. But what are the problems with funds? And if you've been reading the newspaper over the last few years, you'll have seen some of these problems manifest. One is a thing called style drift. So you might go into a fund thinking it does one thing, and actually over time, the fund manager starts to drift away from their original mandate, perhaps out of a bit of boredom, perhaps they're not making the returns they used to. So regulators have got to be on that, because basically the fund may not be doing what it claimed to do on the tin anymore. Secondly, gating. That's quite a serious one. That applies to unit trusts, the one at the top here only. What's happening there is a fund manager suddenly thinks, crikey, I've got a lot of people wanting to sell this fund. Words got out, things are going wrong. So the fund manager then, basically, in order to be able to give sellers their money back, if you like, redeem units, they've got to dump some of these assets in the fund. And as they start dumping assets in the fund, getting rid of them in order to pay back people who want to get out of the fund, that can create a kind of stampede for the exit, if you like. And gating is the response. It's not a great response, but it's basically the fund manager shutting the door and saying, for the time being, you cannot buy or sell units in this fund. And that can be the beginning of the end. Not something that can happen with an investment trust or an ETF in the same way, but it can happen to a unit trust. And we've seen it happen with one or two high profile names recently. And then there are costs. You pay for all of these benefits, basically. And that's something to be wary of. Funds don't do what they do for free. So I always recommend anyone thinking of buying a fund gets under the bonnet to understand what the impact of fund charges on their returns will be, for example, because funds, to put it bluntly, have several ways of getting money out of you. There's the initial charge. They might waive that. There's the annual management charge, and that can be made up of quite a few things for running the portfolio on your behalf. And there may then be an exit charge in a few cases for getting out. So it's important to understand that. So that brings me back to, well, hang on a minute. If, for example, I'm worried about a fund getting gated, if I'm worried about style drift, if I'm not actually sure what the fund manager is going to do on my behalf, and I might want a bit more visibility over it, what's the alternative? Well, oddly enough, the alternative is what Rachel's been talking about. You could set up your own portfolio with, say, 30 stocks in it. There are capital asset pricing models that tell you, what the minimum number you need is, but let's say 30 stocks. And that may well give you the sorts of performance you get from a similar fund, except that you can see what's under the bonnet, you can see what the costs are going to be, and arguably you've got a bit more control, especially if you're doing it yourself or with the help of, say, an investment manager, over what's in there and what stays in there over time. So there's no right answer. Do I create my own portfolio? Do I just give the whole thing to a fund manager? Do I do a bit of both? There's no right answer. It depends on your preferences. But on that note, I will hand you back to Rachel.
Thanks, Tim. Yeah, at Killik, we do use a lot of funds. Often, as Tim says, we do use a mix of both. So if we're buying individual shares, it's very easy to research the companies if they're based in the UK or the US. It's much more difficult if they're based somewhere like China. So often we'll have a portfolio of companies based in the UK and the US, and then we might use a Chinese or emerging markets fund manager just for that small proportion of the portfolio. So funds definitely do have their place. Now, I'm going to share my screen again, and we can have a look and see how our portfolio is done. So, unfortunately, I am quite sad to say this, but we have made a loss over the few weeks that we have been investing. But it's important to bear in mind that we've only been investing for a very short time, and generally we would invest for much, much longer, ideally years. But here's the current scores on the doors. So in the second column from the right, you can see the gain or the loss on each investment since we originally purchased them. And then in the very right-hand column, you can see the gain or the loss that's happened since the last session. So that's what I'm going to focus on mainly. I think most of you have been here for most of the webinar sessions that we've had. So you probably know that some of the main gains that we've seen have been because the economy has started to reopen again and people have got excited about things like air travel, and they've piled into things like IAG, which owns British Airways. So since we started the portfolio, we're very much up on that. We've seen people selling out of the stocks that have done really well in lockdown. So that would include things like Peloton. That's why that stock is down so heavily. And we've also seen quite a significant strengthening of the pound against the dollar. And because we're based in the UK, but lots of our stocks are based in the US, we've actually lost out because of that currency move. So those are really the main reasons for the big moves you can see since we started our portfolio. But let's take a look at some of the moves we've seen over the last 2 weeks. And I've highlighted 4 particular ones in yellow that I really want to focus on. So IAG, owner of British Airways, since we started the portfolio, we're up nearly 25%. So overall, it's been very good. But over the last 2 weeks, the stock is down 9%. So what is the reason for that? Well, as we mentioned at the start, people had been really excited about the economy reopening again. Everyone was booking holidays, getting excited about meeting friends again, etc. But now it appears that we might be heading for a third wave of the coronavirus, particularly in Europe and Germany in particular. And also there are some concerns that we are having some trouble getting the vaccine distributed to where it needs to be. So that has caused a few concerns. And we have started to see some headlines like this. And so the government is sort of advising us that it's not a great idea to be booking summer holidays just yet. And so that has caused a bit of concern for investors in IAG. And that is one of the reasons why we have seen the shares selling off a bit over the last couple of weeks. And so here's the share price chart for IAG over the last couple of weeks. You can see, from October onwards, it's been a great performer, but just over the last couple of weeks, it has come down a bit just because people are being a little bit more cautious about booking holidays. So that's IAG. I'm just going to scroll back to my portfolio chart. We've then got Newmont, which is the biggest gold miner in the world. That's really come up because the price of gold has come up. So when investors are a bit worried about the economy or the market, often they tend to buy gold because they believe gold is a safe investment. So because of this worry about a third wave of the coronavirus, investors have been a bit worried. They've moved into gold. The price has gone up. That's good news for gold mining companies such as Newmont. I'm going to talk about that a little bit more in a second. I'm just going to mention Beyond Meat, which is obviously a company that makes meat substitutes. And when it first started, it was a very unique company. There weren't many other businesses doing what Beyond Meat did. But now we've got a lot more competition coming in. Some of those competitors are starting to undercut the price of Beyond Meat, and that's causing a bit of concern. So I'm going to talk about that in a bit more detail. But first of all, I just want to talk about commodities. So a commodity is defined as a basic product that is interchangeable with other products of the same price. So examples are oil, gold, or sugar. No matter where you buy those things from, they are exactly the same. So if you are a producer of those things, you've really got no control over how much you sell your product for. And anyone who's buying your product will simply go to the cheapest place. So you've really got no control over your pricing. So if you're an oil company, you've got to sell your oil for the current price of oil. If you try and put the price up, all your customers are going to go somewhere else. So your share price will very much depend on the price of the commodity that you are selling. So Newmont is a gold miner. It really is entirely dependent on the price of gold. It has very little control over what that price is. You've then got companies that might use branding to try and give themselves a little bit more control over what they're selling their products for. So some of you might disagree with this example. I've got Coca-Cola and I've got Tesco's Classic Cola. Arguably, those two things are pretty similar, but they're sold for very different prices. And that's because Coca-Cola is branded very differently, and many of us believe that we are getting a better product, and therefore we're willing to pay a lot more for it. We've then got companies that do offer a genuinely unique product, and people are always willing to pay a lot more for that. And these types of companies have a lot more control over their pricing. So one example is Apple, the iPhone. It's very unique. If you want access to Apple's operating system, the App Store, you've got to buy an iPhone. And because so many people are now sort of locked in and addicted to the Apple world, they've got no choice really other than to pay whatever price Apple demands. You've then got luxury products. So I've got a Louis Vuitton handbag here. No one else is allowed to make handbags with Louis Vuitton written on. Therefore, it's a unique product and people are generally willing to pay a bit more for that. So why is this relevant to Beyond Meat, which I mentioned earlier? Previously, when Beyond Meat first started, it was a very unique product and it could charge a very high price because no one else was making these meat substitutes that Beyond Meat is making. However, over the last couple of years, lots of competitors have come in. They're making a very similar product to Beyond Meat, and therefore these meat substitutes are becoming more like commodities. Beyond Meat's product is being undercut and the company has no choice but to start charging a bit less. And that's one of the reasons why the company is making a bit less profit and therefore the share price has come down. And so I believe in the first session, Tim talked about something called an economic moat. And that simply means that you are offering a service or making a product that is in some ways unique and that is difficult for other companies to copy. So when you're investing, it's a great idea to look for companies that do have that unique product or service because it gives them more control over their pricing and allows them to be more profitable. So that's my comment on Beyond Meat. And finally, we've got NIO down the bottom there. So NIO is an electric car company based in China. We talked about NIO 2 weeks ago because the share price had come down quite a lot. And the reason then was that the company had published an update saying it was really struggling to get hold of enough of the materials it needed, and it wasn't sure whether it would meet its production targets. The share price has worsened since our last session, and I think some of the reason for that is this great update that we've had from Volkswagen. Volkswagen is clearly competing with NIO in the electric vehicle space. Volkswagen is also selling into China, so the fact that Volkswagen is clearly doing well is probably bad news for NIO. So I think that's probably one reason why the share price has weakened a little bit since our last update 2 weeks ago. I've got a couple more charts here. So this is Newmont, the gold miner. So you can see that it has come up quite a lot over the last couple of weeks since our last session. We've talked about commodities. And then just before we finish, as I said, it is a shame that our portfolio has made a loss over the short time for which we've been investing, but it is really important to think about the longer term. So I just wanted to show you a couple of longer term share price charts to finish on. Now, previously we've talked about different types of companies and how different types of companies can perform in different ways at different times in the economic cycle. And we often talk about so-called growth stocks and so-called value stocks. So growth stocks are shares that are seen as being quite expensive, but investors are willing to pay those high prices because they believe the companies are growing quickly and that they will continue to grow quickly. So growth stocks tend to be more expensive, and examples would include things like technology stocks. You've then got value stocks. So these are companies that look cheap in share price terms. Often it's because they're out of favor. Often it's because they're in an industry that people aren't feeling particularly confident about at that particular moment in time. So examples would be things like oil stocks and banks. And also companies like IAG, which owns British Airways. Now, the S&P 500, that is that index that shows the biggest 500 companies in the US, but we can separate that into two separate sub-indexes, one looking at just the growth companies and one looking at just the value companies. So here are those two sub-indexes over the last 6 months. In the yellow, we've got the value, and in the blue, we've got the growth. You can see that the value has massively outperformed. And that's unfortunate for our portfolio because most of our companies are quite growth orientated. But what's important is to look at it over a longer period of time. So this chart shows us that over 6 months, growth has definitely underperformed. If we look over a year, we can see that actually growth has outperformed. Growth companies have performed a lot better during lockdown because they're much more suited to people working from home and spending more time at home. The value companies, as you can see, didn't really do a lot for most of last year, and then they've picked up a bit more recently as we've started to hear a bit of a plan about the economy reopening again. So that's a 1-year chart. And now this is a 20-year chart. So what you can see over this time period is that growth has massively outperformed. So you can see that growth has really benefited from this uptake in technology that we've seen over the last decade, and that the growth index has massively outperformed the value index. So this is why it's really important to think about the long term when you're thinking about what to include in your portfolio. So hopefully that's helping us to leave it on a bit more of an optimistic note. And so that's the last of the presentation there. So I'll leave it there and we'll leave it open for questions. So as always, I'll give you a couple of minutes just to think about any questions that you might have, and then Tim and I will do our best to answer those for you. Okay, we've got a couple of questions coming in. So the first one is a very nice question. Will there be any other webinar series that lead on from this one? We haven't planned anything specific yet. What we're hoping to do is run a repeat of this one later in the year, possibly around September, October time. We haven't planned a follow-up to this particular one, but we will be sending out a survey at the end of this webinar series. So if there is anything that you would like to see, if a lot of people would be interested in a follow-up, maybe we could have another look at this portfolio in a month or 2 months' time, then let us know. And if there is a lot of interest, then we would be happy to offer that as well.
Just on that note, Rachel, I think probably should mention my videos. If anyone wants to delve a little bit more into the educational side of things, let's say, how do things work type videos, at our website, killik.com/learn. There's a series of free videos. You can get straight in there, organized into different categories down this side. Some on shares, some on funds, foreign exchange is in there, investing principles, or on YouTube, there's also Killik Explains, all educational, nothing more than about 10 minutes long. So there's another way to delve in a bit deeper.
Great. And another question, does Killik offer any work experience opportunities? And if so, would we be able to access this? We're not offering any at the moment, largely because we're working at home and it's very difficult for us to offer any work experience with everyone being at home. What we have talked about doing is doing a bit of a series like this, but aimed at people who want work experience. So we'd bring in people from different departments at Killik. So you'd hear about investment management and what that actually involves on a day-to-day basis, wealth planning and what that involves, research and what that involves. So again, if there would be much interest in a series like that, then let us know in the survey and we will seriously consider offering something like that. Tim, do you want to take the next one?
Number of stocks, that one?
Yeah, take that one.
Yeah, so good question. How do I work out the right number of stocks for my portfolio? Now, frustrating answer coming up. It depends. So some science. So there is a thing called the capital asset pricing model, devised by academics but applied in real life, which suggests, to cut to the chase, that you can eliminate most of what's called the single stock risk from a portfolio, not the risk of the whole market crashing. That's different. That's called market risk, but the single stock risk. And single stock investing, as we said, is quite dangerous, by holding something like 15 to 25 stocks. The higher up that spectrum you are, the more you eliminate. But does that mean you just go for 20 in the middle? No, not necessarily. Some funds will hold 100 stocks. Maybe that's a little over the top. A passive tracking fund that tracks the FTSE 100 will hold about 100. Oddly, not exactly 100 usually, but we're getting on for 100. But I know some private investors who only hold a dozen stocks because they have a very targeted approach to their portfolios and they understand the risks they're running. But, you know, I think for anyone who's relatively new, I mean, Rachel, I guess, you know, 30 plus is a sort of sensible benchmark because, you know, it's, if you concentrate too much, it's very difficult to get the sector, perhaps the currency, perhaps the diversification angles that you want. Equally, there is a point where you've probably got too many stocks.
Yeah, so it's a balance between having a good level of diversification, but then not having so many stocks that it's difficult to follow them. So for the purpose of this webinar series, we've only had 12. And in reality, that's not really enough for a full portfolio, but we couldn't really have had more for this series because it just wouldn't have been possible to talk about them all. But I agree with Tim. I think 25 is probably a good starting point, and I would happily have more at the outset because that does make the portfolio safer. We've then got a question on, should we consider investing in Deliveroo straight away since they're going public this month, and what are the risks? So I know that they have been offering shares directly to their customers, so we have had a lot of questions about this. They've only just published their prospectus, which is a big document they have to publish before they go public. And at the moment, we're still sort of working our way through that and trying to get to grips and to understand the company a little bit more. The difficulties with investing in an IPO is that you're not going to have access to the same information as you would have with a company that's been on the stock exchange for a long time. So you are investing a little bit more blindly, I think. You also don't know how many people had access to the shares privately and how many of them are just waiting to dump the shares once the shares goes public. So sometimes you find that when a company lists for the first time, people who have invested, 10 years ago privately are just waiting for an opportunity to exit the shares, and sometimes they can come down on the first day. But then on the other hand, sometimes on the first day there can be so much interest from other investors that the share price will spike. So generally I tend to avoid IPOs at the outset just because the early days of trading are so unpredictable. I don't know if you have any additional comments on that, Tim.
No, I think that's pretty comprehensive.
Actually, one more risk that I will mention, there have been a number of major shareholders, or major investors rather, commenting on Deliveroo this week, saying they're not comfortable investing in Deliveroo because they don't believe they treat their workers very well. So we are seeing more and more that investors only want to invest in companies that act in a moral way, and treatment of workers is definitely an aspect of that. So I think that is definitely a consideration. Tim, the final question is about books, so do you want to take that one?
That's a good one. On further reading, apart from videos, for example, what else could I read? Well, funnily enough, I was, lucky for me, I was talking to one of the UK's most successful, currently fund managers, Terry Smith. He's a devourer of all things investing. And one of the things he recommended, which I have to say I agree with, is if you go to the Berkshire Hathaway website, you'll find Warren Buffett's letters to shareholders. And Warren Buffett is a very, very, very experienced, probably one of the most successful all-time investors. You may have heard of him. It's Warren Buffett, B-U-F-F-E-T-T. His letters to shareholders, if you can find them, go right back to the 70s. They're a really good read. As, by the way, is Oak Tree Capital's Howard Marks. I don't know if Rachel would agree with that. Is another. He does a letter every year, and it's got some fascinating insights in it. A couple of other recommendations: How to Understand the Global Financial Markets by a chap called Stephen Valdez. A little bit old now, but it's a good one. And then there's How to Read the Financial Pages, which is more about ratios and analysis, by a chap called Michael Brett. But Rachel, you may have one or two others. I don't know.
I've got many others. Let me try and pick my favorites. So there's a market commentator called Scott Galloway, I just find him really funny. He's just really easy to understand. He has great ideas, but he does a lot of commentary specifically on Facebook, Google, Alphabet, and Apple. And he has just published a book. It came out in November, and it's all about life after the coronavirus and the impacts that will have on the stock market. But it's really easy to read, really funny. And so I would definitely recommend that. I also really enjoy books about different companies. So I've just read a book called The Ride of a Lifetime, which is written by the Disney chief executive. So that I really enjoyed. And there's also one about Nike called Shoe Dog. So lots of great books about individual companies as well. So what we'll do actually, when we send around an email after this webinar series, we will pop a list of these books in there as well, just to give you a record of those.
Just had one pop in. Do you want me to start with what key traits make a good investment manager? The reason I'm going to go first is to give Rachel a chance to come back at me on this one. What you want from an advisor or investment manager is someone who is not a normal human being. Now, what I mean by that is investors, you want knowledge, you want experience, of course you do. You want to check charges out and that, but fundamentally, what sort of person do you want? It's going to be someone you like, someone you trust, yes, but actually they need to be the kind of person that won't do the sorts of things that investors often get wrong. So they won't be too emotional, they won't panic sell, they won't get obsessed with a particular sector or stock idea, or let their portfolio get skewed because one stock does amazingly well, and then all of a sudden a balanced portfolio gets completely out of kilter. So they tend to be quite rational, quite unemotional. They tend to be the kind of people that apply logic, calm, rational thinking and science to investing rather than emotion. And there's nothing wrong with emotion. I mean, crikey, at a dinner party, you want some emotion, right? But in investing terms, and there's masses have been written on this, I'm compressing it, it can be your enemy. So Rachel, I'm suggesting you're a tiny bit dull. Sorry about that.
Yeah, I'm just emotionally dead.
Come back to me on that one.
No, I think those are all fair points. And for anyone who is looking at investment management as a job, I mean, I absolutely love it. I think it's really, really good fun. It's so varied. I think you have to be good at talking to people and explaining difficult things to people in a simple way. So I really enjoyed that part of the job. You have to be good at speaking to people and getting them to trust you, because if you are going to invest their money, you need to know a lot about their financial situation. You need to know how much they're worth, what they earn, what their ambitions are for their money, what they're investing for. And a lot of people are quite uncomfortable talking about things that personal. So you need to be good at having those conversations with people. Then you also need to be well read, you need to understand the markets, and you need to be good with the numbers as well. So I love that about the job, because there are so many varied aspects.
Yeah, it's a mixture of art and science. You've got to be able to communicate with people. You've got to be able to talk to clients, get messages across, not patronize, not use too much jargon. But equally, you've got to be able to be quite rational about what they're trying to achieve, and then building something that will achieve it.
Yeah, agreed. We just hit time, but we've got one more question coming in, so we'll just do this one quickly. Do you think Cathie Woods is a good fund manager to watch and listen to? I think she's great. Some great ideas. Her performance has been very, very good. She is very growth orientated, so her portfolio can be quite volatile. And I would also say she's actually become so popular that she's almost got a bit of a cult following. So when she goes on CNBC and says she likes the stock, sometimes the stock moves just for that reason. So you've got to be a bit careful with that, but I think she is great.
Yeah.
Oh, we've one more question. Let's take this one more. To become an investment manager, what would be the best course to take at uni? I took economics, so I did do one with a financial background, but I don't think that's essential. And actually at Killik, we take people from all different backgrounds, and we actually really like the mix of knowledge that brings to the company, because whatever degree you do, that's going to be relevant to a particular sector of the market. So I'd say just go with what you enjoy.
Yeah, I did a history degree and then became a chartered accountant. And then I've done various other things since. So really it's picking something that you enjoy, you're good at, and doesn't obviously close down too many options, but an awful lot of degrees won't close down those options, I think.
Yeah, because the exams you need to do to be an investment manager, you do those afterwards anyway. So it doesn't really matter what degree you've done before.
Yeah.
Brilliant. Well, we'll leave it there. We're just after 5:45. So thank you so much to all of you to come along to these 5 sessions. We've really enjoyed it. We've found it really interesting looking at your ideas. And so we hope it's been really interesting for you too. You will get a survey afterwards by email. So if there's anything you liked or didn't like, or you'd like to see more of, just let us know, and we will bear that in mind for whatever we do offer in the future. But thank you very much, and have a nice evening.
Bye.